do me. All right. Well, I'm glad that y'all are here to join. So we're going to kind of kick things off. So Austin was kind of the first person to kind of, well, not the first, but in this sort of format, first person that I kind of started teaching. And he started live trading in August-ish, and then did something like 70% in a single quarter, based on what we the strategies I showed him. So we're here today to become professional traders. So I'd start off by maybe just going into that exact term. So the meaning of professional in this context. So John Luke, you're a professional firefighter. What would be the difference between like a professional firefighter and an amateur? Like I can go, if something's on fire, I can go grab a fire extinguisher, out of the closet or whatever. So what makes you a professional though?
So how if you're breaking into a house, right, and there's a fire in there, so you're making forcible entry, you might think like, oh, there's this giant window right next to the door.
You can handle any situation, basically. You're trained on, and like what chemicals are needed for certain types of fires, and what chemicals you shouldn't use on other types of fires, and what gases come off of certain you have a skill set to deal with a much wider range of things than just a normal person like me grabbing a fire extinguisher and just hosing it down. So in this context, it's like the ability to deal with any situation, and also like to do so without freaking out, without panicking, without emotion. When it comes to like trading, do you think would be the difference between an amateur trader and a professional?
Probably be trading based off of personal feelings instead of the rule book of what the rules that you need to lay down to trade without personal feelings attached to it.
So yeah, that's definitely a component of not allowing emotion to be involved. What else would be what is like the main key to being a professional trader? Like personally, I would say it is probably consistency, because it's like if you want to make a consistent income, that's very different from some months you make a lot, some months you lose a lot. Excuse me. The main point is consistency. So I guess you all know the what do they call it? Like the levels of competency. Is that the right word? Something like that.
Yeah.
Of like the going from, what is it? Unconscious incompetence, as our mutual friend Mr. B would say. That means you're stupid, but you don't know you're stupid. Remember?
Oh yeah. And then there's conscious incompetence, where you know that you're stupid. And then there's conscious competence, where you have to think about what you're doing as you do it.
Yes.
And then you get to unconscious competence, where you don't have to think about it, but you do everything correctly.
Yeah, you know exactly what you're doing. Like, you see whatever the situation, whatever the problem is, and you're like, boom, okay, I can deal with this. I know exactly what to do. I don't even need to think about it. And there's also, the fact that becoming a professional, I think one of the best possible comparisons would be like flying aircraft. Like, it's, there is risk involved in trading, and when you put your hand to scratch your nose or whatever, it jacks with your filter. It was really funny looking. Anyway, flying an airplane would be a great example. So like for someone who has absolutely no training or experience, flying an airplane would be a very risky proposition. But for someone who has the training and has the skills and has the unconscious competence and knows exactly what to do in any given situation and knows how to keep perhaps potentially dangerous situations from turning into very seriously dangerous situations, flying an airplane is like no big deal. Like my dad he was a pilot in the Navy and has been flying for like 50 years now. And so there's like absolutely no situation in an aircraft that would ever, especially in stuff that he's experienced with flying, there's nothing that could ever happen that he wouldn't know how to handle outside of, a wing falling off or something completely, insane like that. That's just irrecoverable. There's nothing that would happen that he wouldn't know how to deal with. So with this, one of our goals here is to get you guys to the point of unconscious competence with respect to entry and the management of your trade and the risk management of your trades. And we're going to talk a lot about emotion or managing our emotions, really eliminating our emotions. We're going to talk about the psychology. We're going to talk about all of the basic terminology. I did this once with Jonathan. This is like the second time around for Jonathan. I'm going to try to add in. I made some notes of some other stuff that's worth throwing in there as well. That we didn't cover on the first class. We're just going to kind of do the same thing over and over and focus more and more on like the points that maybe you guys have questions on or are struggling with, and we're also all going to be as you guys go live, we're going to be discussing everything that you're doing right and everything that you do wrong, like day to day. I am going to have you guys probably start off with doing simulated trading, but that's more just to learn the controls. Simulated, despite the fact that it's working with the same data, is not the same as real money. It's just not the same. You don't have the emotional strains. You don't have, there's so much less of a challenge with simulated trading. The benefit of simulated trading is learning how to operate the platform without making mistakes, fundamentally. John Luke, do you have Thinkorswim installed?
What?
Do you have Thinkorswim installed on your computer?
No, I don't think so. Let me grab it then.
Let me just send you the. Let me just send you a link to.
Oh, I think I have a Schwab account.
Yeah, but do you have the platform installed? Here, I will pop a link up. Do you see the chat on the side here?
Yep.
There you go. Just install that, and then you'll log in with your username and password for your Schwab. You may have to like switch. There'll be a thing to switch it from TD Ameritrade to Schwab, but that's I can show you do that when we get to that. Okay. So what was the last thing I said? I just want to make sure everyone had the platform because that's okay. The
simulated trading, learn controls mainly.
Yeah, that's just learning like what buttons do what and making sure that you're hitting all the right buttons in the right order, essentially, and not making some really dumb mistake pertaining to just an execution error with the platform of buying a put instead of a call when you're just those those things that have nothing to do with being wrong about having a psychological issue of a fear or making a risk management mistake. Just literally just hit buy when you meant to hit sell or whatever, just dumb execution errors. But within like a week or so of doing that, once you really kind of are comfortable with the platform, we are going to want to go live. So, and start learning with real money and doing like one contract. That's all you need. Because like if you can do one contract, which will be in this case, it'll be on average about per position about $100 of risk per to $200 of profit. The way that we're going to be starting off doing this. And if you can master like one contract, you can do 100. Like totally. So we're going to want to do it live as soon as possible. Once you I'm thinking now about the Bill O'Reilly thing. Let's do it live. Have you seen that?
I have not.
I gotta show you Bill O'Reilly do it live.
So when it comes to the Schwab account, I don't know if I have access to the account type that you were talking about, because I made it and then I haven't put anything in.
Oh, that's
there
fine.
yet.
As long as you have like a username and a password, you can get in.
Gotcha. Yeah, I might need to screen share with you later, and you can help me figure things up. Because the only thing that I'm concerned about is that all the improvements to the truth that you said to do in order to get the right account. I don't know. They sent me mail.
Well, don't worry about that. We'll get into that later. Because you can actually make a paper money account with just an email, and it lets you use Thinkorswim without having any sort of real account for like 90 days for free. Okay. No money. You don't have to. You just put in your email and like make up a password, and then you get Thinkorswim. I can show you how to do that in a minute. So you can just play with the platform and learn that.
If you haven't done options before too, for the strategy to work, you also have to probably apply for your options trading to get a status there.
Yeah, that'll take like 3-4 days for that application to.
Well, in order to do this strategy, I think you only realistically need level 2.
No, you need 4. You need tier 4.
Do you?
Yeah, because it's writing spreads.
Interesting.
Like writing uncovered. We'll get into what that means in a minute. But no, I was thinking Bill O'Reilly. We'll do it live.
That's tomorrow, and that is it for us today. And we will leave you with I can't do it. We'll do it live. Okay.
What?
No. We'll do it live. Fuck it. Do it live. I'll write it, and we'll do it live. And thing sucks.
All right, now you've seen Bill O'Reilly. Let's do it live. That's what we're going to be doing as soon as possible. Going full Bill O'Reilly. All right. Now, we've kind of established what our objective is here. That is to become professionals. So, let's start off with just the really like most basic stuff. I will pull up my Google slide. Oh, this is good too. We'll talk about this. I love this quote. Strategy without tactics is the slowest path to victory. Tactics without strategy is just the noise before defeat. We'll definitely have to have a conversation about that one. All right. So let's first just start off with like, you guys need to know how to read a chart. That's probably a pretty obvious one. So let me just screen share this, and there we go. Can you all see that?
Yep.
Yeah.
All right, let's talk about candlesticks. So candlesticks are basically how all chart data in this context is going to be presented. I was going to make this slide and got lazy, but they originated in Japan. This is how you're going to read them. So you've probably seen charts that look like this. Do you know how you read these?
They show trends upwards or downwards.
Like you'll see things like this, though. Like I'm sure you've seen charts that look like that.
Yes.
So the way that you read these is each one is representative of a range of data within a certain period of time. So let's just imagine, for example, that this is a 1 hour candle. So in the case of, if it's green, which you can change the color if you want in the platform technically, but if it's green, that typically means up, and people typically have red assigned to down or to a negative change over that period. But let's imagine this is 1 hour. So that means that, like, say, pick a time between 1 p.m. and 2 p.m., just for example's sake. So we'll have here the open. That means like at exactly 1 p.m. When we hit 1 p.m., this candle opens. And that means this is where the price was at the beginning of that hour. And this close means this is where the price was at the end of that hour. And the wicks, as we call them, the skinny line sticking out of the top or bottom, represents the low of that period and the high of that period. So if this is an hour, that means that we started the hour here. At some point during that hour, we were as low as here. At some other point within that hour, we were as high as here, and the hour ended here. Does that make sense?
Yeah.
And for a red candle, you just do the reverse. So the open is the top and the close is the bottom. Candlesticks are also fractal. Do you know what a fractal is?
I do not know what that word means. No.
So a fractal is, let me look up the definition. Well, it means, this explanation is way too long. In mathematics, it's a geometric shape with infinite detail. So you can zoom in infinitely close to it, and it just keeps more detail, keeps emerging. Or you can zoom infinitely out from it and see a bigger and bigger picture. So what I mean by that is like this. So let's say this is a 1 hour candle. So we had it open here, close here, open, low, high, close. And this is 1 hour of data. Now that 1 hour candle could be displayed also as two 30-minute candles. So this is 30 minutes of data, and this is 30 minutes of data. And within each of those 30-minute candles, we would have an additional two 15-minute candles. So this is the same hour as this, but displayed in 15-minute candles. So we have this candle, open, low, high, close. Open, low, high, close. Again, we could display this 1 hour candle as 6 10-minute candles, or 12 5-minute candles, where this is all of these drawings, all 5 of them are basically representative of exactly the same set of data, but just in smaller and smaller time frames per candle. But this is the same data. It's just the lower the time frame you go to, the more detailed it's going to be. And there are some platforms that I think have, Thinkorswim goes down to a minimum of 1 minute, which even 1 minute is quite frankly impractical. There's just too much chop for it to really be worth anything or have any value to us. But there are some that go down to, I think, 5 and even 1 second candles. And then you can go out as far as you want. Like if you're looking at a there's practical limitations to how small you can get. So it's maybe not a true fractal in that sense, but you could go as far out as potentially even displaying, like Coca-Cola has IPO'd in like the 1920s or whatever. You could hypothetically display everything from Coca-Cola's start in like 1920s all the way to the present, like 100 years. You could display that as one candle if you wanted to, hypothetically. That would be as far out as you could go, or you could display it as 1 second candles. So that's what I mean, where you can, this is basically just compressing or decompressing the data set. Does that make sense?
Yeah.
That's the difference between the time frames. We also need to just go into, this is going to be kind of a quick rundown, and then I'm going to pull up the platform and we'll kind of start delving into that. Trend. This is another thing that's important to understand. These are very simple things. So trend is, everyone knows what a trend is, but the key thing is this here. It says an uptrend is characterized by having higher highs and higher lows, and a downtrend is characterized by lower highs and lower lows. So what does that look like? Like this. That's an uptrend. And you can see it has, high, low, higher high, higher low, higher high, higher low, higher high, higher low, etc. That's how we define an uptrend. In the real world, is it going to be this clean? Generally not. But that's a very basic illustration of what that looks like. And I just noticed that the top text, the title, is the same for the downtrend, because I'm an idiot. But this is, ignore this. This should say a downtrend is defined by lower highs and lower lows. But it's the inverse. Same deal. And then we were talking about candles and how they're sort of fractal. That's also true of trends. So this might be a daily trend. Let's say this is 5 days. Let's just imagine that. Over 5 days, we might have, over those 5 days, it's a consistent uptrend. Where over 5 days, we have a high, a low, a higher high, higher low, another high, But over those 5 days, we could have one day is an hourly uptrend, and the next day is an hourly downtrend, and then an hourly uptrend and an hourly downtrend. And then we could look at any one of these days on a 1 minute chart. And within that day, we would have multiple changes from an uptrend to a downtrend on a 1 minute time frame. So I say this to say this will apply more once we get into kind of heavier stuff. But basically, if you're trading on like an hourly trend, it's a good idea to be aware, to be cognizant of the higher the trends that are going on at the higher time frames. If we're looking at an hourly, if that's where we're making our decisions, we want to be cognizant of the daily or the weekly. And then this is the way that I typically define a change in trend, and which again, these are all very, very clean drawings. It's usually not going to be so clean in the real world. But like yeah, sorry.
What would the biggest trend you'd be looking at? Like what time frame is the biggest one that you're going to seek for relevancy? Like, is it 2 weeks, a month?
Like, I would look at weekly, like where each candle is 1 week.
Okay.
That's
what time period is relevant? Like, if you see a stock, like, are you going to look at it over a 3 month spread on a weekly candle?
Well, when you're looking at the weekly chart and you're trying to be aware of the really big time frame, that like what the like Goldman Sachs, for example, BlackRock, whatever, those guys are not looking at a 1 minute chart. They're looking at a weekly chart or a monthly chart because they're big enough to actually move the price of assets. So, it's good to be aware of those higher time frames. Although with what we're doing, we're going to be taking advantage of short-term trends, typically on a 1 hour chart. But we always want to be cognizant of what's going on in the big picture.
So that's something I wanted to expand on too. I think one way to answer that question is it depends on what you want to get into.
Yeah.
So
yeah.
if you're looking to buy a stock to hold it for a few years, or trying to figure out using technical analysis or looking at the trends, if you think this is going to be good for 6 months, then you're going to want to look at higher time frames. But if you're wanting to leverage something over the course of a day, 2 days, 3 days, you want to look at weekly should be the highest time frame, and then daily really is where you should be looking, I would think, and then hourly as well if you're looking at that short of a time span.
I agree. It depends on your objective. Like, there's going to be, unfortunately, a lot of questions that you have. The most honest answer will be, it depends, unfortunately. So it depends on your objective. Like with what we're doing, Austin and I focus very heavily on the 1 hour. But then also for like, if you're looking at what equities you want to buy to hold, potentially like for your whole life, then yeah, you want to be looking at weekly and monthly to see like, what is this thing gonna, where is this thing trending? What is this looking like over 20 years? It really depends on the objective that you have. So, I mean, it's sort of like if you're in the Marine Corps, so, what weapons and gear are you taking on an operation? It's like, well, it depends on the op.
Yeah.
If you're doing something in the desert and you're going to be out for a week, or if you're doing something in the snow, you're going to be out for 2 days, you'd take very different equipment. If you're fighting insurgents or you're fighting a professional military, are you going to be going up? Are you going to be dealing with armor or just dudes with AKs?
And sandals.
Yeah. Depends on. It would change the equipment and the weapons that you want to bring on that mission. So it's the same thing with this. Like, it depends on what you're trying to accomplish. And that's part of what we're going to be doing here is you're going to be learning, how to pick the right tool for the job, so to speak, with respect to indicators, time frames, risk management rules, a lot of different stuff actually. But this graph here, we were talking about mostly when a trend changes. So the way that I typically define it is if you have like an uptrend where there's higher highs and higher lows, once it's made a lower low and then broken that lower low, that's when I would define the change, the trend has changed.
So if it's 2 lower lows in a row, it's a trend
not
change.
2 lower lows, but the moment it breaks the previous pivot low. We also call these pivot points, pivot highs and pivot lows. So we have a pivot low, then a pivot high, and then it breaks below that. Because once it breaks below that, by definition, it has to make another lower low. But once it breaks that second break, we got like here, we have the low, and then we have one break, makes a lower low, and then that second break, that's where the trend has changed. That's how I would define it. Okay. Price. Okay, I'll just leave this slide up and let's let's talk about price. This is super, super important. I'll stop presenting for a moment. This is where this gets really, really interesting, because price is like one of the least well understood concepts, and it's honestly one of the simplest, but it's not necessarily intuitive. So any given asset is going to, I mean, I'm sure you're all familiar with the concepts of supply and demand. Of, if demand increases and supply remains the same, then the price goes up. And if supply decreases and demand remains the same, then price goes up. And then price continues going up until supply comes in to meet the demand or to satisfy the demand. Like there's that applies to markets like this as well. So with any given and if you're taking notes on the also, like, these are some good things. Like, I don't know if you're a note taker or not, but this will be on YouTube, like as a unlisted video probably, so I can send you a link. But every asset is going to have actually two separate prices. They're called the bid price and the ask price. Basically what that means is what price buyers are bidding. So what price the demand is saying, if you're on the buying side, you say, this is what I'm willing to pay for XYZ asset. And then on the other side of that, you have the ask price, the price that sellers are asking. If you bought a house recently, and I'm sure you paid attention to the housing market a bit. So, low interest rates, for one, in that case, resulted in a lot of buyers who said, well, now I can afford more. So my bid, what I'm willing to offer for a house is higher. So that increased the demand. So let me pull up a note here, or where's the friggin' whiteboard? All right. All right, here. Okay, can we all see this? Let me see. All right. Can you guys all see this?
Yep.
All right. So, John, like, you got the whiteboard? Can you see it?
Yeah, I can see it.
All right, excellent. So we have I'll just put some notes up here. All right. We got bid, price, buyers are bidding. Ask, price, sellers are asking. All right. And there's always something called the spread. What is it? Difference between bid, ask. Did that cover my other note? Damn it. All right, there we go. So let's look at like this. We'll put this here. And we'll put this here. And I'll put this in the middle. You'll see what I'm doing in a second. So let's just say that we have an asset that is let's say it's $100, and we have 99. That's a terrible 9 and 101. I'll start off with a really simplistic example here. So if we imagine like the example that I gave Jonathan was like eBay auctions previously. So with eBay, like let's say that you want to buy, an iPhone 13. And on eBay, if you've ever done an eBay auction, you'll know how, or actually this will be better for you, John. I think you'll relate to this one more. Gun broker. So if we do a gun broker auction, the seller might they might have one of those just auctions where you can just keep bidding until the auction ends. Or they might have a buy it now option, like a fixed price, where you can just pay that, boom, credit card, and then the listing is closed, like it sells at that price. So when you have an auction like that, where you have that option to buy it immediately, that price is effectively the seller's ask price. Like if let's say it's an M1 Garand, then the person is crazy and they're hoping for another crazy person on the other side, and they have it listed with like $5,000 as the instant buy option. Let me find, like, hold on. Let's actually.
It would be probably closer to like 1,500 is like, that's the top end that you can probably ask for one, and the bottom end is like 850 is what they used to go for a while ago. So they would probably be asking for the top price of 1,500. But
all right, let's explore bid ask dynamics. All right. Oh, I was right.
what the hell?
Okay.
$5
So
grand.
Whoa.
10. Oh, it's a sniper. Okay. Even still, get the hell out of here. All right. But this is a perfect example, okay? So here we have the buy it now price, $5,000. The starting bid is $25.25. So what that means is that, and it says 10 days left. Okay. So that means that, someone can bid 25. You could start at this number. You could start with this bid, and then someone could outbid you. But this price, these bid amounts are fundamentally a reflection of the maximum amount that buyers are willing to pay. Whatever this number ends up being when this auction ends, that's a reflection of the bid price on M1 Garands. Does that make sense? Yeah. Like, let's say that this finishes with the bid at, 3,000. Then 3,000 is the bid. In this case, the buy it now price, where the seller is saying, I'll give it to you right now, immediately, that's $5,000. So if this topped out at hypothetically 3,000, what's the difference between 3,000 and 5,000?
$2 grand.
Yeah. So the spread, the bid ask spread, would be in this case $2,000. That is insane that they're. Are you thinking about selling yours now?
No, I'm not thinking about selling mine now. I'm holding on to that thing.
Yeah, you're right.
That thing's all original furniture with matching serial numbers. I'm keeping it.
Yeah, that's a fair point. I want to see if there's any that have some bids. but no, these are crazy money. But like that would be the spread. So like let's now imagine that we have like a a security here. So in this case, let me go back to sharing the whiteboard. So let's imagine that we have a bid-ask spread of 2. So we have a stock. We'll just call this XYZ stock, and its bid price is $99, and its ask price is $101. So that would be like from here, a spread of 2. That's the spread here. The ask price, this is how we're getting into like the key fundamentals of literally how markets move. So the ask price is saying, I will, hold on, where's my brain? All right. Ask is, I will sell at this price or greater. So if there's a seller asking 101, will they take 102?
I mean,
course
that's
they would.
above what their ask is.
Well, if they're asking 101, they're basically saying, I will accept 101 or more.
Okay.
And then what that order is, what sets the ask is something called a limit order. This is also an important term. So we have 2 types of orders. We have limit and market.
Hey, you forgot about buy it open.
Shut up. So these are the fundamental building blocks of a market: limit orders and market orders. These are super important terms. Tattoo this on your forehead in Braille if you need to.
In Braille. I'm not blind.
Yes.
I
I don't know how that would work. I don't know how that would work, but tattoo it in Braille. All right. Now, limit orders. A limit order is, it's saying, let me make a new frame here. I'll put that back up again. Limit
Sorry, I'm
All right.
breaking out the amphetamines for studying.
focus a I'll actually do this. Within those types, we have two fundamental kind of fundamental concepts here. Let's see, sell limit is there. That's a good arrangement, I think, for explaining this. So, Jonathan, do you remember what does a limit order mean?
No, I can't remember.
It's fine.
Or no, hold on. Let me think. I'm not gonna give up.
All right. A limit order.
So a limit order, so it won't sell below that price, but you're not guaranteed
Right.
that it'll sell or that it'll fill.
Okay, right. And so what a limit order, the difference between a limit order and a market order is a limit order is saying if it's a buy limit, this is super important. A buy limit means I will pay X price or less. Okay. I will pay this or less. A sell limit means I'm willing to sell this for this price, for Y price or greater. I will not, it's setting a limit. It's saying that I will not sell this below here. I'll sell it for more.
Like a Toyota owner with a clapped out 2006 Tacoma that says $5,000 firm. I know what I have.
Yeah, exactly. A buy limit is saying I will pay X or less.
Okay.
So, if we're going back to that example of the M1, the sell limit price would be the person that puts $5,000 as a buy it now. They're saying, I will sell it at this price or more, effectively. Then there's a buy market order and a sell market order. So these are the other key building blocks, I suppose, of a market. So a buy market and a sell market work like this. Going back to the example of an M1, a buy market order is where you actually pay the 5,000 because you want the M1 really, really bad. And you're willing to pay the price that the seller is asking. You following?
Yeah.
So think of a buy market order in the case of a market, of a financial market, like it's like a heat-seeking missile. So if we buy Apple and we use a buy market order, it's going to go and find the nearest opposing sell limit order. So if we do buy market, that's saying, okay, we're just going to go and find the nearest opposing supply. And by contrast, if we do a sell market, the sell market is going to go, we're going to be going down in price until we find the nearest opposing demand or the nearest buy limit order. The difference between a sell limit, or a limit order in general and a market order is that with a limit order, you are guaranteed to get filled at a specific price or better. But you're not guaranteed a fill. You're guaranteed a price, but you are not guaranteed a fill. What a fill means is basically someone else taking the other side of your order. So if we put an M1 up for sale on Gunbroker, if you put your M1 on Gunbroker for 5,000, you are guaranteeing, if you put that as the buy it now and there's no auction, you're guaranteeing a fill. You're guaranteeing yourself a price. If you put 5,000 as buy it now, that gun will not sell for less than $5,000 if it sells. You are not guaranteed that someone will buy it. On the other hand, if you're on the flip side of that, if I'm M1 shopping and I go to one with an auction, and let's say I bid 3,000, that would be a buy limit order. I go into the auction thing, type in 3,000, send that order. I'm guaranteeing myself a price. If I win that auction, I will not pay more than 3,000. But I'm not guaranteed to win the auction. I'm not guaranteed a fill. But if I go to your listing for your M1 and I just click, okay, I want it really bad, buy it now. That would be a buy market order where I'm accepting whatever price the seller is asking, and I'm guaranteeing myself a fill, but I don't really have control over the price. Does that make sense?
Yeah.
And by contrast, a sell market order would be like if you took your M1 down to the pawn shop and just said, what do you give me for it? And they say, $1,500, and they pull out the $100 bills or whatever. If you take your M1 to the pawn shop, you're guaranteed a fill. You're going to sell it, but you're not in control of the price.
Got it.
So limit orders, you guarantee yourself a price, but not a fill. Market orders, you guarantee yourself a fill, not the price. Are we following?
Yep.
Very good. How are you guys overall feeling about this? Is this a good refresher? I feel like I'm explaining this actually much better than I did the first time with you, Jonathan.
Totally, but I mean, it was good the first time too.
Okay. Appreciate
But
it.
like the different examples help to integrate the information much more.
I like the slides.
Sure.
The slides are a plus. They really help me.
Yeah.
Okay. Yeah. Awesome. Okay.
I think you explained this a lot better as well than the first time. There was a lot of filler the first time, and I feel like it's more concise now.
Okay. Well, I'm getting there. I am
Really good. Yeah.
I'm just a cat.
It's the cat.
We can put this on TikTok. Cat explains bid-ask spread
You know what? The
to a
algorithm,
pirate and a cowboy.
Finance
All right.
Bro TikTok might like it.
Oh yeah, this is some gold here for real though. All right, let's move along.
I was gonna say go follow the X account TikTok investors. They'll make fun of you for it.
Any press is good press.
Would it be hilarious if you got a whole bunch of women signing up for Boundless because they just really like the cat?
That would be
That'd
great.
be cool.
Stanley Cup explains this stuff. That's how you do it.
Top C. Top cat. Instead of get it top C instead of top G. Never mind.
Top
This
C, I
is
get it.
when you say roster. Shut the hell up.
Now this is good. I do want to preface that I don't know how everybody's doing for food. I'm good to hang on.
No,
I do
great
have-
too.
I have a
If
quick.
you guys need to snack though, mute your mic preferably while you're, horking down a cheeseburger or whatever, but feel free to eat. There's another thing that I also
I actually will need to leave in a few minutes. I'm close to my destination, so if I hop off randomly, don't be alarmed.
all right, yeah, we're gonna be going pretty much all day, so feel free to join us again.
I'll have to switch to my phone when I'm on my way to my doctor's appointment, and then I'll
All right,
be
that's
really quick, and then I'll come back right back.
All right, cool. Okay. There's another thing that I meant to mention, but didn't before. So you guys understand that the ask price here. So going back to our example again, if it's 101 versus 99, if we do a buy market order, then we're going, that order is going to go find the nearest opposing supply. The nearest, it's going to go market orders fill limit orders. That's how this works. So that order is going to go fill the nearest opposing sell limit order. So it's going to go up, 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 up till it finds the nearest supply. It's like a heat-seeking missile looking for supply. If we do a sell market order, it's going to go down and find the nearest opposing demand. Now, let's talk about how price changes.
What did you say? Sell market orders. What?
A sell market order is going to go down. It's like, think of it like a heat-seeking. Okay, this is a better way. Buy market orders are surface-to-air missiles. Sell market orders are air-to-ground missiles. A sell market order is going to go down until it finds the nearest demand, the nearest buy limit. A sell market looks for the nearest buy limit. A buy market looks for the nearest sell limit. I know it's a lot of like, limit and market and sell limit, buy limit. It's a little bit, can turn into a bit of a tongue twister, but.
Yeah, that's why I'm just trying to make the notes Barney style.
Yeah.
All
right. Very good. Okay. What do we have next? Anchor swamp. Let me see here. All right. For you, let's see. All right, we're going on. I don't know how long we've been going here. Austin, what do you think would be the next thing to go into here?
Let's see, you've done order types, you've covered trend.
Order types, trend. All right, how price actually moves. This is a really good one. All right. So we've talked about trend. We've talked about these candles, what they represent. But let's discuss how prices actually change, like why they change in a financial market. So if we have XYZ stock trading at 100, what does it require for it to go to 101? Oh, I got some ideas going on now. I know what we're gonna do for the next hour. Actually, I got it all. Yeah, okay, I got it. I know what we're doing. All right. What does it take for it to go to? If it's at 100, how does it go to 101? What are the actual mechanics of how that works?
Not enough supply, so people are willing to pay more than what it's worth because of the scarcity.
But what if it's worth more than it's trading for?
That means that people are dumping it for one reason.
I think you're thinking about it more in a macroeconomic scale, but it's
a
little bit less.
I'm thinking like really, really simplistically, like the actual, I almost want to say physical mechanics of how that price changes. If it goes from 100 to 101, what
more valuable?
All right.
It's good. It's got to be more valuable.
What? Okay. Let's play with this idea a little bit.
If we've got a finite number of ask orders and a finite number of bid orders, maybe that'll key in on a good direction to go.
Yes. All right. We'll start off with this little graphic here. Let me Let me spread these out a little bit more for some room for notes. All right, there we go. This is good. All right. Stock is here. Make it green. All right, it's here. And at every price, we're going to have sell limit orders. All right, SL. So at like, there's going to be sellers at 105. There's going to be sellers at 104, 103, 101, 102. I skipped 102. And let's just say that the right now, let's say that the ask price is 101 and the bid price, what buyers are bidding is 100. But then we also have sellers at, buyers who are not, right at the bid, but have buy limit orders that are lower. Buy limit. So think of each of these red lines as a certain number of, as an area where you have a number of buyers. Like there's people that maybe they're not a buyer at 100, but they are a buyer at 97. And there's buyers at 98. And there's buyers at 99. And one other concept I meant to go into is when you have a spread here, like 99 and 101, there is also a name for the average between the two. Let me just put that up here real quick as well. That is called the mark. So in this case, the average between 99 and 101 is the mark. Sometimes you'll also see that displayed as mid. So either way, mark or mid, what that means is the average between the bid and the ask. It's like the middle. Does that follow?
Yep.
Okay. So here, how would we move this thing? Like let's say that we're what are the mechanics of how this would change? If these are this right here, big stack of big stack of buy limit orders, right? I should probably have reversed those colors. That would make more sense. But that's okay. We'll ignore this for the moment. All right. And then here we got a big stack of sell. All of these are levels, but we have the highest buy limit is at 100 and the lowest sell limit is at 101. So, depending on whether you use mid or the bid or the ask to determine your price, it's, the price of this asset is kind of somewhere in here, average. So what would have to happen for this price to go up?
You put in buy market orders, or people would start putting in buy market orders.
Yes. Correct. So, let's just imagine that there are, hold on. All right, let's imagine that at this price here at 101, we have, come on, you bugger. All right, we have 20 people selling. 20 sellers here. And at 102, we have 25 sellers. And at 103, we have another 25 sellers. And at 100, we have 30 buyers. And at 99, we have 25 buyers. And so on, like this. All right, but these are buy limits. I should specify. Limit. These are sellers with sell limit orders. All right, are we all following this so far? Yes? No?
Yeah, I'm just.
All right. So we want to move this thing. What would we have to? Let's just pretend, for example's sake, that instead of 20 sellers, it's shares of stock. You know, these are very, very unrealistically small numbers. But let's say this is, 20 sellers each selling one share. So we want to. How would we move this thing up? It's not a trick question at all. I promise.
If you can't buy it at the price you want, you get it as close as possible to the price you want.
Well, all right. If we're a buyer, how would we move the price up? We have two problems in front of us. All right. The first one is that we have the limit price is at 100. That's the highest end of where you have buy limit orders. And then we also have, on the other side of that, we have the ask price at 101, where we have 20 sellers. So what type of order would we use to eliminate those 20 sellers? Not a trick question.
Is it a buy
Remember our
limit?
previous slide. Now, buy limit is saying I will pay X price or less. Although technically, yeah, you could use a buy limit, but you could just put it in where the limit price is 101. But
it's a buy
you could
market,
technically
then,
do that. But a buy market, exactly, yeah. So let's say we put in a buy market for 20 shares. So that goes up, up, up. It finds the nearest opposing supply, the nearest sell limit order. And we have taken these guys out. They're gone.
Mhm.
Okay.
And now there are only people selling for 102.
Yeah, there's only sellers at 102.
So that means the actual price, even though it used to be 100, because the only people who are selling for 102, the actual price has moved up.
Yeah, but now we've widened the spread. What else do we also have to do as part of this process? So that was a buy market. Now we need to bring the bid up with buy limit. And now, let me get rid of this. The mark is now going to be here. Let me do that with a highlighter. It looked better. Now this is the mark, somewhere in there.
Okay. That makes sense.
And what if we want the price of this? What if we want it to go to 102? Then what do we do?
We got to buy everything at 102. The buy
Yeah,
market, and then it switches it up.
Yeah. We do a buy market at 102. And we have to keep sending those buy market orders till we have eliminated all opposing supply at 102. And then we bid it up to, we do buy limit. This is how institutions move things. This is how BlackRock and Goldman Sachs move things.
They just buy all the supply that's really freaking close to
Yeah.
the actual
Yeah.
price.
You buy the supply. They call it take and bid. There's two ways of phrasing it. There's take and bid, which means you take the other side of the opposing supply and then bid higher. Every time when you bid higher, that means buy limits to bring the bid price up. Take out the opposing supply, bid the bid price up. Put in buy limit orders to bid that up. There's also hit and offer, they call it. Hit and offer is the opposite. That's where you sell at the market to take out opposing demand, and then put in sell limit orders to reduce the ask price. So take and bid and hit and offer are good terms to know. Now, if we want to go to 103, what do we do? Not a trick question again.
Can you say what those things again? I'm trying to do
Yeah. The
take and
yeah, here.
bid.
Take and bid.
Hit and what?
Offer. So what we're doing here, this example is like take and bid.
Which is buy all the supply now that you control it, and then you set your own price.
Yeah, exactly. Like you eliminated the opposing supply at these prices, which then allows you to bring up the bid price. All right, let's do the opposite now. Let's say that we have here let's say we have I'll make this a little bit cleaner now. These are our these are our prices. And let's say we have here all right. So we have buyers on one side. All right. So these are buy limit orders. These are all of these people, these buyers, the buyers at 100 have buy limits. They're saying, I will buy for 100 or less. You got it? These guys are saying, I will buy at 99 or less. These guys are saying, I'll buy at 98 or less. 97. I'll buy at 96. I'll buy at 95 or less. 94 or less. On the flip side, we have sellers. These guys are saying, I will. Sorry?
No, I was just
Sorry?
yawning. Sorry.
Oh, you're good. You're good. You're good. Definitely, like, let's, you know, to don't just like, you know, sit there. Like, try to, like, if you have any question, like, let me know. Like, I want to try to make sure this is like really well done. and also like for people that might watch this later on too, and for making content, like definitely let's keep it a conversation. So I'm not talking about myself here. So these guys, they're saying I am willing to sell at 101. These guys, I'm willing to sell at 102. I'm willing to sell at 103, 104, 105. And then somewhere in the middle here we have the mark. Now, this drawing is clean now.
Yeah,
this
that
is
good.
This is
That
clean.
one's good.
All right, I'm satisfied.
That one's really good.
All right. Now, what if we wanted to do the opposite? If we wanted to do bollocks. What would be an example of hit and offer?
Would be
Well, okay.
what would we do?
Now we're on the selling side. We want to sell this thing. We want to push the price down. We want to push it down. All right. What do we do?
You'll get a sell
All right,
market
first,
order in.
where's the ask price?
Ask price is at 101. Well, it's at 100. Somewhere in between.
Ask?
No, the ask price
Which
is at
one is the ask?
100, right?
You sure?
Did you switch the colors?
Well, that doesn't matter. Buying, I just used green to represent demand.
Okay.
So yeah, I did switch them, but where's the ask price in this example? You have the mark here, the mid.
They were asking for 100, and they're trying to sell for 101.
Who's
The buyer, right?
the buyer is not asking, bidding 100. That's the highest bid. 101 is the lowest sell limit. So 101 is the ask.
Gotcha.
So remember that, like bid is always like, just think of it like bid and buy both start with a B.
Gotcha.
Well, this would be like, because in this case or in this example, we're trying to sell for.
Well, in this case,
101
let's imagine
less.
that we're a big institution and we want to push this price down. But I just wanted to I'm just asking about bid and ask as just a refresher on the terms here. So we got okay, again, where's the bid?
The bid's at 100.
Yes, sir. Where's the ask?
The ask is at 101.
Yes, sir.
So
Okay.
the sellers are going to do a sell market order to
All right.
sell
Yeah.
to the nearest buy limit.
All right. So if we want to push this price down, we would need to, as you said, sell market at, we put in a sell market order. That's going to go down. It's going to find the nearest opposing demand, and it's going to whack the demand. All right. So now the bid price is here. This is the bid. That was too strong. Now this is the bid here. But we want to push the price down. So what would happen here if we used a sell market order and we eliminate all the buyers at 100?
Now the price is 99
Well,
because
the
there's nobody
bid
else
price is
selling at
99.
100.
The bid price is 99. The ask is still 101. So basically, all we did was by eliminating this supply, or sorry, this demand here, we've widened the spread. All right, we got 20, 21. All right, this is actually a really interesting example of the mechanics here. So like, have you ever wondered why, like, for example, Elon can't sell very much of his Tesla stock at once?
Price is going to fall down too far.
Well, let's talk about the mechanics of why. So we got 21, 2, 3, 4, 5, 6. All right. Let's imagine that we put in a sell market order for 120 shares. Sell market. How is that going to work? We put in a sell market. What's it going to do?
You're just going to go to the,
It's the heat-seeking missile.
yeah, it's going to
Get
go
air
to
to
the
ground.
closest one. So it's going to drop to,
Yeah, but it's 120. So it's going to go to nearest one. All right. 20 have been filled. We've got 100 left. What's it going to do?
Take the next level until it gets to the 120 shares.
Yeah. Okay. Now we got 80 left, 60 left, 40 left, 20 left, and that order is filled. All right. Where is the bid price at this point?
94.
Yes, sir. Yes, sir. It's at 94. Where is the ask price?
95,
No.
It's still 101.
93.
Yeah. 101. So what we've done here with this market order is we've guaranteed, remember, a market order, you guarantee yourself a fill but not a price. So if we had a huge market order, it would just keep going down, taking opposing it would be taking out the opposing demand, but there's no guarantee of, like where that demand is. It might just have to keep going down until you have filled that entire market order. But now we've got the bid and the ask really, really wide now. Now, what would happen if I came in and I put in a buy limit order? Buy limit. So I'm saying this price or lower, bidding for one share back at 100. What would happen?
You want it to fill?
No. I'm putting in a buy limit. So I'm saying I'm willing to, after this market order for 120 has taken out all of the supply and the bid is now down here at 94. Right?
Okay.
Then I remember the bid is always, the bid price is the highest limit, the highest buy limit order. So this we just sold 120 shares and depressed price down to we took out all of the demand between 100 and 95 or 94 rather.
Mm-hmm.
Then let's say I come in and I put in a buy limit order at 100 for one single share, just one.
So you're willing to buy one share at 100 or less?
Yeah, I'm saying I'll buy one share at 100 or less. And the ask is still up at 101. What would happen?
I mean, it'd keep
Not
going
a trick
down.
question.
It'd keep going down until.
Well, no. Okay, there's now this gap. So we've got bid of 94, ask of 101. All of the demand has been eliminated between 94 and 101. And then I come in with one share, buy limit at 100. What do you think would result?
So you'd have to find the nearest opposing demand.
Well, let's just say this is like someone else. Okay, a random person puts in a buy limit at 100 after this market order has been filled.
Mm-hmm.
What would happen? Hint, bid. That's the hint.
Buy limit. I'll pay X price or less. So
So you'll buy at 94.
After this order has the sell market order has been filled. So it's eliminated every buyer between 94 and 100, right?
Okay.
So we have this wide spread. The ask is still at 101. And then someone comes in and even though they're only bidding, their order is for 1 share at 100. What would happen is the bid price would go straight back up to 100. That would now be the bid. Do you see why?
Why?
Well, because that would be that now the new highest buy limit order. So even though, we just spent all that money getting, this eliminating this 120 buyers, once that order is done, as soon as one person comes in bidding on 1 share, the bid price pops straight back up to where it was. So that's why when big companies like big banks need to move the price of an asset, they can't do it with big orders.
So that's why they hire like armies of people to to run smaller trades so that they don't have to cast as wide a net.
Well, no, not exactly. So what they have to do is, all right, demand, supply. All right. What they have to do is what I described before, the hit and offer or take and bid. So if they did this, what would be the point of that? Because you'd have spent a lot of money buying these shares, and then the second that one person submits an order, a buy limit order for 1 share, the price would pop straight back up to where it was.
Which it would, because
And then your average here, the price is now, it's back to, bid of 100, ask of 101. But on this, our average fill would have been like 97. That'd be our average price. You see what I'm saying? Like here, we would have bought 20 shares at 100, 20 at 99, 20 at 98. So our average would be like somewhere down here. So we'd be immediately in this thing. We'd be in a bad spot. The price would be $3 average, on average, $3 higher than what we just sold it for.
So you just ruined your average because one trade would throw off your average to being.
Well, we would have
higher.
Just sold for way less than this is worth. And now if we want to push this thing up or down, like in this case, we're talking about pushing it up. So here, let's imagine that we want to push it down. Also, let's take a brief detour and talk about short selling. Do you know how? I'm going to stop presenting for a second, or maybe I will. All right.
Wait, one sec. I'm not going to be responding for a tad bit. I'm going to go to the bathroom. I'll be right back.
All right. Tell you what, you guys want to take a brief wee break?
Yes.
Sure. Yeah.
All right. Let's take a wee break for like 5 minutes or so, and then how about 8 minutes? Let's reconvene at 1.
Sounds good.
All right. Cool. We'll at 1 we'll get into short selling, and then talk about how banks move prices both up and down, and then after that we'll get into options and kind of on the platform and stuff like that. And John Luke, after your wee break, let's also get your Thinkorswim all logged in, and so we can start on that.
Gotcha. I'll start with my Schwab credentials after I'm done. Thank you.
All right. Sounds good. I will turn off the recording, and we are off the air.